Welcome to the Money Watch Show. It is Saturday, March 15th. Bum, 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 bum. All right. We're not going to go relive Caesar. We're just going to say it's been a rough few weeks to be an investor. Yesterday, we did end on a positive note. But since we are the program that takes the mystery out of your financial life, I thought it might be a good time to kind of check in with you about investing. And I am Jill Schlesinger, CBS News business analyst and certified financial planner. And I'm joined by my co-host, Mark Talercio, who is the executive producer of Everything Jill on Money, as well as a certified financial planner. Been a rough few weeks, huh, Mark?
Hello, Jill. First of all, let me say this is very strange because usually when we do this, we don't see each other. But today I see you.
Oh, yeah. Well, yeah. Are you going to be on camera for the next thing? I'm going to fix this right now. You guys aren't going to see. I look kind of, that's all right. We're doing a video after this. So, Mark, correction for the NASDAQ. We touched on a correction for a minute this past week for the S&P 500, meaning a drop of more than 10% from the previous high level. You know, the S&P just made a new high like 5 seconds ago, like about a month or so ago. So, you know, look, gang, it stinks because I wish I could tell you that these events were not going to continue, but uncertainty is really the theme right now. And, you know, there are a lot of changes coming out of this administration. Some of them are unknown as to the impact on the economy, but investors tend to sell first and ask questions later. So, Mark, were you unnerved by the selling? I thought it was sort of orderly, actually.
No, not unnerved, but it's been a crazy few days, couple weeks, extreme highs, extreme lows, more lows than highs. Kind of reminds me of the early days of COVID when things were just bouncing all over the place. But
oh yeah,
I can honestly say when things are going bad, I never look.
That's good. That's good. By the way, we are just at our 5-year anniversary on the Jill on Money show of going daily. By the way, just that was on March 14th of 2020. So if you want to subscribe to that podcast, it's a little bit different than this one. It's really the same. It's just that we really want to dive into deeper aspects of your financial building blocks with this program. We want to go a little bit back in time. Maybe you don't have all the jargon. So that's why I said correction, more than a 10% drop from the previous high. By the way, we have corrections all the time. We have 10% drops all the time. We had one last year, actually, in the middle of the year. Doesn't mean we're going to be there forever. And Mark, I think a lot of people tend to feel like, well, if the stock market's down, then that must mean that we're going to go into a recession. What's your view on the connection between the market and a recession?
I would say nobody knows what's going to happen. That's the bottom line. If you do, please let me know.
Yeah, right. Send us your crystal ball. We'd love to hang out with you. I think the other part of this is the economy. It's weird because the economy is slowing down right now. There's no doubt about it. Like that is sort of an absolute. We know from data that the stock market is not part of that. It's just that we know that consumers felt a little tapped out after spending a lot of money last year. We know that high interest rates, still high interest rates, are weighing on some folks. We know that still high prices are weighing on some folks. And so we came into the year knowing that there was going to be a slowdown in the economy. Then on top of that, you put these on again, off again tariffs and big job losses among federal government workers. And you start to get this witch's brew of like, oh my God, maybe there's going to be a recession. And, every investment bank has upped the odds of a recession for this year. Okay. But you know what? A lot of times they're wrong. They really are. I mean, also, a lot of times the Federal Reserve is wrong in their own projections. So we don't have to worry about it. There'll be a recession at some point. And recession, just the definition, some of you might have heard like, oh, recession, that means 2 quarters where the economy shrinks, where GDP is minus. That's actually not how we describe a recession. That's like the shorthand. We actually have a body that names when recessions actually come. It's called the National Bureau of Economic Research, and NBER is the body that says, hey, here is where the economy bottomed out. Here is where it started the expansion. Recessions in general, I think I looked this up. and we're going to play a segment. I think they're 8 since 1967, 11 since 1950. They range in length. You know, you can have a really long, horrible recession where the economy is just crap for 18 months. That's what we had in the Great Recession, which started in December of 2007, officially ended in June of 2009. But guess what? It felt a lot worse than that. It took a long time to recover from that. And then we had the COVID recession, which was 2 months, literally 2 months. That was it. A huge drop in output. And then boom, we come back strong. So I don't know if there's going to be a recession or not. But Mark, let's play the segment that aired on CBS Mornings earlier this week with anchors Gayle King and Vladimir Duthiers, where I talked a little bit about what was going on in the markets. Again, this was after the Monday of trading where stocks completely got shellacked. They went down again a lot throughout the week, but yesterday there was some reprieve. But we are looking at a pretty nasty moment for an investor. So when we come back from this segment, Mark and I are going to talk a little bit about how you can calm yourself down and not actually freak out when you go through cycles like this. So Mark, let's play that segment.
Well, to help us make sense of all this economic turmoil, let's bring in CBS News business analyst Jill Schlesinger. Jill, always good to have you at the table, but let's just discuss right away. Massive stock sell-offs, major federal job cuts, unpredictable tariffs. I'm thinking now's the time for people to run around with their hair on fire, but I know you're going to say no. Now you're going to say no, now's not the time to panic. And if now's not the time to panic, when is?
Well, first of all, we all feel that. Uncertainty breeds that anxiety within us. So you have this feeling, I want to do something. And so instead of doing something like messing around with your retirement account, I'm going to have you all take a deep breath with me, like, okay, and now we're going to concentrate on the part of our lives we can control, our own finances. You know, I've talked about this before. I call it the big three. When you're feeling anxious, you want to try to look at your emergency reserve fund. How much money do I have? Safe money built up. I'm trying to accumulate a safety net for myself. If I have that 6 to 12 months of my living expenses socked away, can I start chipping away at my debt, my student loans, my credit card balances, my auto loans? And once I have that, if those two things are good, hey, let me just put a little bit more money in my retirement account. There's nothing that makes you feel better than buying on the cheap. You now see that stocks are down 7, 8, 10%, sometimes 15%. When you put new money into the market at these levels, you got a discount. Who doesn't like a discount?
Yeah. But they don't have new money to put into the market. That's why I'm always confused when you say put more money in. Well, people are freaking out right now.
Well, let's look at two different types of investors. Yeah. The type of people who are putting money in already because they've got a retirement account.
Yeah.
Maybe if you can afford it, you put an extra percentage or two in. That works. A lot of people are going to be new investors. They're going to get a big tax refund. When you get that money as a new investor, this is a perfect time. Again, presuming you've got those big three covered. To be clear, these are frightening times to be an investor.
Yes, yes.
But to be an investor means you have to be able to endure the ups
and the downs.
And the downs.
So do you basically say you need to sit tight?
Well, I would say stick to your game plan. Don't start messing around with your portfolio. And remember...
Vlad, you're a business background.
Well, so the question, of course, Jill, is the president of the United States recently declined to rule out the possibility of a recession in the United States, but help put those recession fears into context.
Yeah.
Listen, recessions are part of what we call a normal business cycle. We have upswings and we have downswings. And the downswings happen very infrequently. You know, if you go back to 1967... we've had 8 recessions, meaning the contraction, the shrinking of the economy. Mm-hmm. Now, by the way, sometimes the economy doesn't have to shrink to have the market sell off. In 2022, the economy grew by 2 percentage points. The stock market went down. So they don't move in lockstep. But what is clear to me is that when people feel this fear and anxiety, think, how can I take control? I can take control by doing something in my personal financial life.
So, Mark, I think that it is always good for me to have my little panic protection plan. You know, I first came up with this idea of a panic protection plan. I thought it was in 2008, but then actually it was when I was still an advisor 100 years ago. I first started talking about a panic protection plan in 2000 when this whole tech sector melted down. So that big three, I think, is really important. Also, making sure that you don't have any cash that you need over the next 12 months at risk. I can't tell you how many people we've talked to who will say like, oh, well, you know, I'll just take it out of the market. When? When did you say you were going to take it out of the market? Are you going to wait till after it's down 10%? No risk. No risk for money you know you're going to need within 12 months. I mean, Mark, when you were doing when you were buying your house, didn't you keep that money in safe, non-risky assets?
Yeah, everything was in our brokerage money market account. Any new money that we were putting aside, we just put in there.
I think it's also interesting when people will say to me, well, I have to pull all my money out of the market because I'm retiring next year. Ho, ho, ho. Wait a minute. You are investing for a long period of time. You are really looking, even if you're retiring tomorrow, and let's say you're 60 or 65 years old and tomorrow's your last day at work. You don't need all of your money in cash at once. That money has to keep growing, has to grow faster than the inflation rate. This is the whole point of investing. It is to basically try to have your money work for you and try to make sure that that money grows faster than the rate of inflation. That's it. It's not more than that. Mark, do you think that some people who are going through this right now are going to be kind of no worries, hang in there, or do you think there's some panicking?
Well, I can tell you there's panicking. I can just tell you that based on the stuff coming into the inbox. But what I would say, it's like if you're still investing for the long haul, 5, 10, 15, 20 years, this is a good thing. This is like walking into a department store. I don't know who does that anymore.
Thank you, Jill.
This is like going shopping and finding everything that you need at a discount of 10, 15, 20%.
Mark, there's a couple of other things that I think are important that people would be better focused on actually concentrating on their own personal financial lives than worrying about their portfolios. And one is to really watch the fees that they're paying. If you've got one of those big fat managed funds, maybe you replace it with an index fund. I love advisors. I have many friends of mine who are advisors. I was an advisor 100 years ago. But if there's just somebody who's selling you stuff like an insurance policy or just saying, oh, I'm going to put your money to work without doing a real financial plan that's not like there for you, man, I think that's a good way to save a few bucks. Look, I don't know where markets are going. I don't know where the economy is going. What I do know is so much of this is out of your control. If you are a long-term investor, this works. It really works. And you know what, Mark? When we interviewed David Booth from Dimensional.
I was just going to say, Tune Out the Noise.
Tune Out the Noise is the name of that documentary. And I got to tell you something. I just thought that guy had so much wisdom. And it was a great reminder to me of how you can really be your own worst enemy in so many of instances about, your financial life, but mostly your investment life. And you don't have to be a pig. You don't have to feel fearful. You have to put your strategy in play and then not mess around with it. So, gang, all we ask of you is that if you're feeling anxious, if something's going awry, if you really are, maybe you just started investing and this is your first time experiencing this downward pressure, get in touch with us. Go to jillonmoney.com, click the Contact Us button, and check the box if you'd like to come on the air. While you're on that website, don't forget to sign up for the free weekly newsletter. And you can maybe even subscribe to our other show, Jill on Money. You can do that. Or you can subscribe to this show if you haven't already on the Odyssey app or wherever you find your favorite podcasts. Oh, Mark, it's so great. Mark is our co-host and executive producer and king of all things web. We drop our episodes on Saturdays and Sundays. Please leave us a rating and review wherever you listen. Don't forget to lift someone up. Change your work, change your wealth, change your life. Thanks for listening, and we'll talk to you tomorrow.